Okay, so today we're going to look at another adjustment to the financial statements. We're going to look at disposal of a non-current asset. Disposal means when we sell. So a non-current asset is a resource owned by a business with a view of generating cash or profits, and it's owned for longer than one accounting period. Basically, that is what an asset is. So if one is sold, then we have to make adjustments to the financial statements in order to record that sale. Now, non-current assets are normally deemed as capital expenditure and they're placed on the statement of financial position. So they are large items of significant value and they are placed on the balance sheet. But we're allowed to depreciate them over time, and we class the depreciation as an expense on the income statement, and that reduces profit. And also at the same time, we increase the provision for depreciation on the statement of financial position. So whilst we class non-current assets as capital expenditure, as we use the asset and we use up part of its value, that is then placed on the income statement as revenue expenditure as an expense. Now remember that the statement of financial position is going to show the asset at cost minus depreciation to give us the net book value. If you can't remember what net book value is, go back to the previous PowerPoint and have a look at that. Alternatively, just this. So we've got depreciation shown as an expense on the income statement and our non-current assets on the statement of financial position. We can see we show them at cost minus depreciation to give us our net book value. Remembering that net book value is what we think the asset is currently worth. Now, disposal. When we sell an asset, we have to open a very special T account called a disposal account to record the sale of the asset. What we have to make sure that we do is take the asset away from the books. So remove it from the books. Obviously, if we sell an asset, we can't keep it on our balance sheet, so we're going to have to take it out of the ledgers. We must also remove all depreciation associated with the sold asset from the statement of financial position. So that again must be removed from the ledgers. And we also must record the money received into the bank for the sale. Now we're going to call this money that we receive for the disposal of an asset, we're going to call that the proceeds. Right, it's quite important. We understand that the money we receive from the sale of an asset we call the proceeds. Now, the difference between the amount received for the asset, so for the proceeds, and what we think the asset is worth, so the net book value, is going to tell us if we've made a profit or loss from selling the asset. Right, so proceeds minus net book value will give us the profit or loss on the sale of a non-current asset. It's there. That's the formula that you need to remember. Profit or loss on disposal is equal to proceeds minus net book value. Right, so this is quite an important formula that you need to remember. It'll get you some very quick marks in the exam, so it's worth learning this. You can do it as a formula. We're also going to look at how it looks when we take it out of the ledgers as well, but if you can remember this formula, you'll be absolutely sound. Now remember, if the answer is positive, then you've made a profit. If it's negative, then you've made a loss. Right? A couple of important things there to remember. So remember the formula. And if your answer is positive, you've made a profit. If it's negative, you've made a loss. So when an asset is sold, following steps take place. So these are the steps that we need to undertake in order to write the item out of the ledgers and record the disposal on the income statement. So the cost and the provision for depreciation are transferred from their ledger accounts to a disposal account. Now, if you want to make a note, what you're going to do is you're going to credit the asset, debit the disposal, and you're going to debit the provision, credit the disposal. All right. That will take the asset out of the ledger and put it into the disposal, and it will remove the depreciation from the T account and again put it to the disposal. So just again, you're going to credit the asset, debit the disposal with the value of the asset that you're selling, and then you're going to credit the disposal with the amount of depreciation and debit the depreciation account, just to remove any depreciation that asset has accumulated. We then deal with the proceeds, so we'll debit the bank with the amount of money actually received and we'll credit the disposal account. Disposal account's then balanced off, so the balancing figure within your disposal is either going to be a profit or a loss. Now, if the amount in the disposal, the balancing figure within the disposal is transferred to the profit and loss onto the debit, then it becomes an expense. And if it's transferred to the profit and loss onto the credit side, then it'll end up as an income. Right? So they're the steps you need to know. We're going to have a little look at that in a moment, and I'll give you a worked example. But first, let's work out why. Why are we doing all this? So depreciation is an estimate of how much we think an asset is lost over time. The provision showing the total depreciation accumulated. Now, remember that depreciation is only an estimate. Provision's not an objective representation of the value lost. So when you get an asset, you kind of just decide how much you think it will lose each year, right? And remember that when we decided on depreciation, we have to use the same method every year. So if we decide on 10% reducing balance, then for the life of that asset, we will depreciate it at 10% reducing balance each year. Now, that can lead to a point where we're sort of out of whack or out of line with what the asset is truly worth, what we could sell it for. So when we actually sell the asset, we've got an objective value of how much the asset is worth at that point. Whereas the net book value may be very different to that amount. So what we can say is the difference between the proceeds, so what the asset is actually worth and what we've received for it, and the net book value. So the difference between the proceeds and the net book value is either going to represent an overestimation or underestimation of depreciation. So if we've overestimated or underestimated our depreciation, that means that over the years, our expenses haven't been correct, and therefore our profit hasn't been correct. So in accounting for the disposal of a fixed asset, what we're doing is we're kind of fixing this overestimation or underestimation of depreciation. Let's look at it as an example. So here we've got a loss on disposal. So Andrew's got a van. He bought it 4 years ago for £12,000. He's charged 10% straight line for the past 4 years. So he's got a provision of £4,800 worth of depreciation. So that means he's got a net book value of 7,200. So the original cost minus all of the depreciation so far. So we think the asset is worth £7,200. Andrew then sells the van for 7,000. Now that is an objective figure. There's no hiding from it. That's what the van's worth because that's what we received for it. Now we thought the van was worth 7,200. So we've got a loss on disposal of £200. So we thought the van was worth 7,200, but as it was only worth 7,000, we have underestimated our depreciation by £200. So over the 4 years, we should have charged £200 extra worth of depreciation each year, because that's how much value we've lost on the asset. We've actually lost £5,000 worth of value, not 4,000, so 800. So we would have to account for that extra £200 by putting it on the income statement as an expense. Now we can see this in the ledger. So we've got the brought down figure of 12,000 for the van and 4,800 on the provision for depreciation. When we sell the van, what we're going to do is we're going to take the van out of the ledger. And we're going to put that to the disposal account on the debit. As we've sold the van, we can't claim that depreciation anymore. So we're going to remove the depreciation from the provision by debiting the provision and crediting the disposal. Then we'll record the money coming in. So we've received £7,000 for the asset, and we'll put that to the credit of the disposal account. Now, when we balance the disposal account off, we end up with a balancing figure of £200. So that will be transferred to the profit and loss onto the debit side, which creates an expense. So whether you do it by formula or via the ledger, you'll end up with the same answer. Obviously, the formula is a lot quicker, but it will give you the same answer as when you take it out in the ledger. So just to, again, put the brought downs in, then take the asset out, put it to the disposal, take the provision out, put it to the disposal, record the movement of money in the bank with the opposite entry going to the disposal account, and then balance off the disposal. That balancing figure is transferred to the profit and loss, and it will tell you if it's on the debit, it's an expense, if it's on the credit, it's an income. You can also make a profit, obviously. So this time we've got Hamna. She's got a machine used in a manufacturing business, and her total machinery is worth £65,000. Now, one of those machines she bought for £25,000 6 years ago. So in that time, she's charged straight line depreciation of 5% per annum, and that gives us £7,500 on that asset which she has sold. But the depreciation on all assets is £32,000. Okay. So that leads to a net book value of the asset sold of £17,500, being the original cost of £25,000 and the £7,500 just on that individual asset. Now, Hamna sells the asset for £20,000. So 20,000 minus 17,500 gives us 2,500. So that means over the course of the 6 years, Hamna had charged £2,500 too much to her expenses. So she thought the asset was worth 17,500, but it's not, it's worth 20,000. So she charged too much depreciation over the course of 6 years. So she's been creating too many expenses, and that has reduced her profit by too much. So when we sell the asset and we work out the profit on disposal, then what we're going to do with that extra profit, the overestimation of depreciation, is we're going to add it to gross profit, creating an income on the income statement, and that will increase our profit. And what that does, it cancels out that extra expense that Hamna has created over the 6 years. All right. This just balances out your depreciation where you previously potentially got it wrong. At the point of sale, when you work out your profit or loss, that will compensate for the overestimation or underestimation. So let's just look at how to take Hamna's machine out of the books. So remember, her total assets were £65,000. The machinery was £65,000, and her total provision was £32,000. Now, we sold them one of the machines. So we'll take that individual machine out of the machinery and we'll put it to the disposal on the debit. We'll take out the depreciation only for the asset which we've sold. We don't want to get rid of the other depreciation, just the asset that we've sold. So we'll debit the provision, we will credit the disposal. We then received £20,000 into the bank. So we'll debit the bank, we'll credit the disposal. So when we come to balance off our disposal account, we've got £2,500 as a balancing figure on the debit. We'll transfer that to the profit and loss, so it appears on the credit. So therefore, we've got an income. Okay. So in this example, you can see we've sold an asset, but it was part of a larger group of assets. You only need to take out the asset which you've sold, not all of them. And the same for the depreciation. You're only going to take out the depreciation on the asset actually sold. That's why we've got brought down figures for both the machinery and the provision in this example, because there are still assets remaining we haven't sold. Now, sometimes we might part exchange items as well. So that means we take old assets and trade them in to reduce the price of purchasing a new asset. That's going to help us reduce the amount paid from the bank and also gets rid of the old asset at the same time. Now, the important thing for you guys to remember is to pay from the bank the difference between the amount of the new asset and the value of the part exchange. That will all come clear in a moment, but that's a thing you need to remember. Now, the amount of the part exchange is the amount received for the old assets. So the amount of the part exchange is the proceeds. Okay, so we're going to work out this proceeds. So in order to do that, in order to work out the value of the part exchange, you take the cost of the new asset bought minus the amount paid from the bank for the new asset. And that will give you your trading value. So if your new asset is worth £100,000, but you only pay £80,000, then they are giving you £20,000 as the trading value for your old asset. So for the proceeds. So the proceeds or the trading value of the old asset minus the net book value of the asset disposed will give you your profit or loss. So exactly the same formula as previously. Proceeds minus net book value equals profit or loss. But you will need to work out the value of the amount received for your traded in item. There's some steps on how to do it. I would learn those off by heart. Steps are to remove the old asset from the account, then remove the depreciation, so exactly what we did before. Then we've got an extra step. We're going to enter the amount received for part exchange. We're going to debit the asset, we'll credit the disposal this time. As we're not receiving any money for it, you're going to debit the asset account rather than the bank. Then when you buy the new asset, you'll debit the asset and credit the bank, and then balance the accounts off, finding your profit or loss. So just a couple of extra steps. Hopefully you'll understand it more when you see it. Learn that slide off by heart. So here's an example. We've got Mo. He has a car company. He's owned for 7 years a company car. Sorry, he owns a company car. He's owned it for 7 years. The original cost of the car was £23,000. Over 7 years, he's accumulated £15,000 worth of depreciation. He's going to buy a new car, costing 42 grand. Now, Mo's been offered 10 grand as part exchange, so he's going to have to pay 32,000 for his new car. Now, in this example, I've told you the value of the part exchange, But if you're just told the value of how much he's got to pay from the bank from his new car of 32,000, then if you know that the asset costs 42, then you know that you're receiving £10,000 as a part exchange value. So remember, his proceeds on his old car are 10,000. The net book value of his new car, of his old car, the net book value of his old car is £8,000, which is the 23,000 minus the 15. So he's going to make a profit on disposal of £2,000. So how does that look in the ledgers? Well, put the breakdowns in. We've got the 23,000 on the car. We got the 15,000 on the provision. We're then going to get rid of the car from the T account. So we're getting rid of that £23,000 car. So we'll take it out of the car account on the credit, debiting the disposal. We'll then take out the provision associated with that car, which was 15,000. So we'll debit the provision and credit the disposal. Now, we then received £10,000 as a part exchange value. So that is £10,000 towards the new car. So we'll put £10,000 in the car account and £10,000 on the credit of the disposal. Debit the car, credit the disposal. Then we pay £32,000 towards the new car. So we'll debit the car, we'll credit the bank. Now what that leaves us with is a new car worth a total of 42,000. What we've paid plus what we received in part exchange for our old car. So you can see there the brought down is 42,000, which was the value of Mo's new car. It's made up by £10,000 for our old car and £32,000 which we have paid. So that's the car balanced off, provision balanced off, bank doesn't need balancing off. Disposal. So remember, we put the car in that we sold, 23,000. We put the provision in onto the credit, and then we received £10,000 as proceeds as a part exchange towards the new car. So in balancing off that account, again, we got that £2,000. This it appears on the debit. So we debit the disposal and credit the profit and loss. And that means we've made a profit because items on the credit side of the profit and loss are incomes. All right. So that is the process of a part exchange of a non-current asset. These are becoming more and more common in exams because disposal in itself can be quite simple. So don't forget those couple of extra steps where you enter the amount received for the part exchange and entering the new assets. Okay. There you go. Bye-bye.